The performance for the last quarter was just above 1% after all fees. This underperformed the benchmark by about 0.3% over the period. When we look over the past 12 months, the performance after all fees was 6%. So we were pleased on a 12-month performance level, but a little bit disappointed on the last quarter. A couple of the drivers for the performance, the biggest headwind that we saw in the quarter was credit spreads expanding. These expanded over the quarter, especially the first week of April, as Trump imposed his tariffs. We saw a large spike in credit spreads. And as we continued to drift across the quarter, the credit spreads came further downward, not to a level that we saw pre the tariffs, but at pretty close levels. So that was the major headwind for the portfolio. The other minor headwind for the portfolio is we saw short-term interest rates, so the 3-month bank bill swap rate, continuing to drift downwards, and that reflected the RBA cash rate reducing in May and the expected cut in July that didn't actually come about. So we saw the BBSW come down to about 3.3%. On the positive side, as interest rates continued to drift lower, we saw fixed rates drift lower, but that was very positive for our fixed rate investments that we have in the portfolio. So we had one headwind, which was credit spreads, one minor, which was the floating rate, but fixed rates were positive and they're very much a tailwind for the portfolio. How we're positioned for the portfolio going forward is majority of the fund remains in floating rate notes, and we expected to reduce this over time. About 30% of the portfolio is in fixed rate notes. That will gradually increase over the next 3 to 6 months as we continue to see opportunities to invest. There's a couple of good reasons to invest in this product right now. The first one would be if you're worried about all-time equity prices across the share market in the US and Australia, this provides very good diversification and low volatility. And then also when we look at the cash return, the expected cash return of more than 5% after all fees over the next 12 months, we think it represents very good value given the current climate. Our expectations for the next quarter, we expect to increase the level of fixed rate investments over the next quarter, and that will provide a baseline level of yield for the portfolio on an ongoing basis. And we expect the RBA to decrease interest rates by 25 basis points. That should provide more opportunities for us to continue to invest in fairly good assets at reasonable prices.
This fund update has been prepared by SGH Enhanced Company to provide general information only and is not intended to take the place of professional advice, and it does not take into account the investment objectives, financial situation, or particular needs of any particular person. Equity Trustees is the responsible entity for the fund. Neither SGH, Equity Trustees, nor any of its related parties provide any warranty of accuracy. Past performance should not be taken as indicator of future performance, and you should obtain a copy of the product disclosure statement before making a decision about whether to invest in this product. Follow the link in the description for the full disclaimer.